Congratulations on taking a very important step to better understand your employee benefits. This webinar was designed to make you aware of some details within your benefit package that can become problematic if not addressed properly and in a timely manner. We recommend that you take some time to visit with the sponsoring advisor so that your personal profile can be assessed and you can better prepare for a successful retirement. So let's get started. The good, the bad, and the FEGLI. Well, that's a description of an insurance product that is inferior. Now, let's keep in mind, why is it inferior? Well, it's because everyone is approved. There's no underwriting. And obviously that is a good thing for those folks that have underlying health issues or those lifestyle issues that can cause a decline or an increase in premium on a commercially available life insurance policy. But everyone is penalized across the board due to that. And most federal employees are not aware of the fact that the costs increase dramatically over time. Now, there are 4 different options for the Federal Employee Group Life Insurance, which we are going to discuss during this webinar. And the common theme throughout Federal Employee Group Life Insurance discussion is that it is designed to go away. It is not permanent life insurance, and you'll discover that as we go through the webinar. But most do not discover this until they get older, because the costs start to escalate dramatically at age 50 and beyond. So that federal employee that is younger, pre-50, pre-40, and so forth, the costs are really very economical, but they again take that dramatic increase after the age of 50. And many federal employees don't really see that or recognize it until they see that on a leave and earnings statement or a pay stub. And then they start to question it. And keep in mind, in qualifying for life insurance, the younger the better. Now again, in costs going up with the Federal Employee Group Life Insurance, most federal employees cancel it when it is most needed. And all of the money that has been invested in that over time, that money is gone. And it could be thousands of dollars. There's no cash value or living benefits built into Federal Employee Group Life Insurance, as you would find with a good commercially available life insurance plan. Living benefits are benefits that can provide for chronic and critical illness. Chronic illness being long-term care considerations, either in the home or at a facility. So yes, these commercially available life insurance policies will have benefits in there that can provide for long-term care. They can also provide for critical illnesses, such as heart attack, stroke, organ transplant, kidney failure. Those types of critical illnesses, funds can actually be taken out of the death benefit tax-free to help pay or offset those types of costs. The cash value is tax-free. So many people utilize life insurance to accumulate tax-free retirement income. That may be news to many of you out there, but it is something that can be utilized for tax-free income because, again, any benefit that comes out of life insurance is 100% tax-free. Now, Federal Employee Group Life Insurance can be canceled or reduced at any time. Many believe, or there's a misconception concerning Federal Employee Group Life Insurance, that you must be in open season to make any changes. And that's simply not the case. You must be in an open season to add any Federal Employee Group Life Insurance if it is available during that open season. But if you want to cancel or reduce any of your Federal Employee Group Life Insurance options, that can be done with a very simple completion of a form and submitted to OPM. Very easy to replace Federal Employee Group Life Insurance with a superior commercial life insurance policy. The underwriting process with a commercial life insurance policy places you under no obligation, and there's no cost to qualify. So, in your best interest, if you do have federal employee group life insurance, to take a look at a commercially available policy, determine if you qualify, and if it would better your personal situation. Now, getting into the federal employee group life insurance options, we start with the basic option, also known as regular. So let's show you how this death benefit is arrived at. If you take your annual salary and you round that up to the nearest 1,000 and add $2,000 to that, that equals the death benefit. So we've provided an example here. This federal employee's salary, $74,285 per year, rounded up to $75,000. Then we add $2,000, equaling a $77,000 death benefit. Now, keep in mind, the postal employee will pay nothing unless they retire prior to age 65. All other federal employees pay 15 cents per $1,000 of coverage per pay period. So if you take a look at your LAS statement, you can calculate that back and figure that out pretty easily. But that is what you're paying per pay period if you are a non-postal federal employee. Now keep in mind, if you are a postal employee and you retain the basic option into retirement and you retire prior to age 65, you will pay for it. And you have options when you do retire, whether you're a postal employee or a non-postal federal employee, to choose a 75, a 50, or a 0% reduction. The 75% reduction will reduce the death benefit by 75%. It is reduced 2% a month over 38 months, which will reduce the death benefit down to the final 25% of the benefit that you had when you retired. And then at that point, there's no cost. The 50% reduction obviously would reduce the benefit by 50%. And there is a cost for that, and that cost will be there as long as you retain the insurance. You also will have a 0% reduction, and this will cost more than the 50% reduction, and you will continue to pay for that as long as you retain the policy. Now, if we go back to the bottom left-hand side, you will notice that we put together a little example there on the $77,000 and the cost. 77 times 15 cents per pay period equals, in this case, $11.55 per pay period. The cost of that is going to go up if the pay goes up. Now, the premium for the basic option could go up. It hasn't in quite some time, but generally speaking, the only time the cost for basic is going to go up is if your salary goes up, because again, it is based upon salary. Now we come to our FEGLI option B example. The FEGLI option B is the most costly part of federal employee group life insurance. And as you can see, the costs increase dramatically over time. We touched on that at the beginning of our FEGLI discussion. So going through our example, utilizing a example age of 45, a 45-year-old federal employee with an annual salary of $75,000 per year, with option B times 5. Now, keep in mind that you can elect option B up to 5 multiples of your salary. Now, that's your salary rounded up to the nearest 1,000. So you could have B times 1, 2, 3, 4, or 5. For the purposes of our example, we're using a federal employee who has chosen an election of 5 times their salary, making that death benefit $375,000. Now, as you can see, as we had mentioned earlier, when the federal employee is younger, it's really a bargain. So if you're 45 years old and you're paying $65 a month for a $375,000 death benefit, that's a bargain. But once you get past age 50, as you can see, the cost really increase at a very rapid pace. And as you can see, the federal employee will eventually cancel it. So as we had mentioned earlier, thousands of dollars could be invested in this policy over a period of time and have absolutely nothing to show for it because, again, there are no living benefits. There's no cash value. It's strictly death benefit only. And it does become unaffordable over time. Again, FEGLI is designed to go away. Now, the replacement options for federal employee group life insurance are term life insurance. Term life insurance terminates, and it usually comes in a 10, 15, 20, 25, or 30-year term. Depending upon your age would determine which one you could qualify, or the maximum term you could qualify. Then we get to whole life. Whole life is a cash value policy. It is a permanent policy. So it's going to be there for the entirety of your life in most cases. There is cash value that's built up in the whole life policy, again, that can be used tax-free income. Normally, whole life policies come with a fixed rate of interest. Those rates range usually from a low of, say, 2% to a high of 4%, but an advisor can get some different rates for you with different carriers to determine which one would be best for you. Most whole life policies, not all, but most whole life policies are fully underwritten. When we say fully underwritten, what we mean by that is that you will undergo an exam. And normally a nurse will come to your home or your office, or you can go to the lab and they're going to draw blood. They're going to take a urine specimen, weigh you, check your blood pressure, ask some health questions, all those types of things to determine your eligibility for that policy and at what level you're approved at. Now you'll notice this term guarantee issue, and guarantee issue, higher cost, is for that individual that doesn't qualify for a fully underwritten policy, and it's guaranteed regardless of the health. Now there obviously are some caveats and some conditions associated with that policy and the higher cost, and again, a life insurance advisor can help you understand that and get some quotes for you. UL, IUL. UL stands for Universal Life, IUL, Indexed Universal Life. Now the primary difference between the UL, IUL, and the whole life, because both of them are permanent and they do have cash value, the UL and the IUL, in most cases, not all, but in most cases, will have additional living benefits that we discussed a bit earlier, chronic, critical, and terminal illness riders. So there are some health riders there that allow you to take funds out of the death benefit tax-free to help pay for these types of situations that may arise. The IUL, Indexed Universal Life, the term index indicates the way that the policy increases in value. So you have policies that have a fixed rate only, which are normally whole life, and the UL has a fixed rate of interest applied to the cash value. The IUL goes one step further and also has a fixed rate available, but adds index crediting or index options. Those indices could be the Dow Jones Industrial Average, S&P 500, NASDAQ, numerous indexes that can be utilized to potentially increase the value or increase the growth over the fixed rate that's available. It does not guarantee to outpace a fixed rate, but it does give greater growth potential, and historically the indexes have outpaced fixed rates in most cases. And it's a matter of visiting with an advisor so you can determine which one is best for you. Now let's get into the survivor annuity benefit. The survivor annuity benefit is the federal employee providing a portion of their pension to a surviving spouse. Now the civil service and the FERS are treated entirely different. The calculation and the makeup of that survivor annuity benefit is calculated much differently. So let's go through a couple of examples here to help you understand how that's going to work. So the civil service retirement system, the civil service employee can leave anywhere from 0 up to 55% of their pension to a surviving spouse, or it can be expressed in a dollar amount up to 55% of the pension. So in our example, the pension amount for this civil service employee is $5,016 per month. The 55% plan costing $479.10. Now, as we can see, very costly. So after the reduction, and this is the net before any other deductions, whether it be health insurance, taxes, and so forth, was $4,536.90 per month. Their survivor annuity amount, which is the 55% plan, is $2,758.80 per month. And that's what will be left to the surviving spouse for their lifetime. It does not pass on beyond that surviving spouse. Whether that surviving spouse collects it for 1 day, 5, 10, 15, 20 years, it ends with the surviving spouse. Now, the next example that we're using is for that civil service employee who has decided to utilize the funds they would be purchasing the survivor annuity benefit plan and do something else with it. Many federal employees will take a portion or all of the funds that they would be purchasing a survivor annuity benefit with and purchasing life insurance with it. Now we'll get into a little more discussion on why that's done here in just a moment. But for the second example, if you notice that the federal employee is not providing, is providing a survivor annuity plan, but only 5 cents per month. Now you might question that and wonder, why in the world would someone only leave their surviving spouse 5 cents per month? Well, keep in mind that in order for a surviving spouse to continue the group health insurance, there must be a survivor annuity benefit plan in place. So if the civil service employee sees the wisdom or determines that it is in their better interest to utilize those funds for life insurance, but they still need to maintain the ability for the surviving spouse to continue the group health insurance, then this is a plan that they would utilize. In other words, they're dialing the survivor annuity benefit plan cost as low as possible so that the surviving spouse can have the opportunity or the ability to continue the group health insurance if needed. At the same time, they're taking those funds and applying them elsewhere, and again, in most cases, that is a good, solid life insurance plan. Then we move on to the FERS employee, and the FERS employee has 3 options, not as numerous as the civil service employee, and that is a 0% or no survivor annuity benefit, the 25% plan, which would leave 25% of the FERS pension to a surviving spouse, the 50% plan, which would leave 50% of the FERS pension to the surviving spouse. Now, concerning the health insurance, the rules are the same for FERS as it is civil service in that the FERS employee must choose a survivor annuity benefit plan, must have that in place at retirement when they retire, or the surviving spouse cannot continue the group health insurance, the FEHB. So in our example, we show a FERS pension amount of $1,843 with no survivor annuity benefit reduction, obviously leaving them with $1,843 a month prior to deductions. The survivor annuity amount in that case would be 0. Then we move on to the 25% plan example, pension amount being $1,843 a month, less $92.15 a month. That 25% plan will cost the federal employee 5% of their pension, $92.15 a month in this case. We then move on, we go to the survivor annuity amount, in that case 25% of the pension amount, $460.75 per month. And then finally, the 50% plan, pension amount $1,843 minus the $184.30, which is 10% of the pension amount. That is the cost for the 50% plan. And that survivor annuity amount would be $921.50. Now, some important things to consider in this survivor annuity benefit discussion. The survivor annuity benefit is not multi-generational. It ends when the surviving spouse passes. I mentioned earlier, whether the surviving spouse collects that pension for one day, 5, 10, 15, 20 years, it doesn't matter. When they pass, the survivor benefit plan ends. It is not multi-generational. The survivor annuity benefit is use it or lose it. In other words, the federal employee is paying into the survivor annuity benefit plan. They're giving that money back to the federal government. Well, if the surviving spouse never uses it, in other words, if the federal employee's spouse passes away before them, then all of that money that was put into the survivor annuity benefit plan is gone. And there are no living benefits for that surviving federal employee. No living benefits such as chronic, critical illness, cash value, and again, does not pass on to anyone else. And the survivor annuity benefit plan is fully taxable to the surviving spouse. Now, the survivor annuity benefit plan is also very expensive, as we had discussed earlier. Our civil service example shows $479.10. Let's say that they paid for that for 15 years at 12 months. They've given $86,238 back to the federal government. And again, what if the spouse passes before the employee? The money's gone. The employee must choose, again, we want to reemphasize, the employee must choose a survivor annuity benefit to allow the surviving spouse to continue the federal employee health benefit plan. Now, keep in mind, as a federal employee, you will not be making a final decision on the survivor annuity benefit plan until you complete your retirement paperwork. Should you plan for it as early as possible? Absolutely. Because if you're going to replace any or all of the survivor annuity benefit plan with life insurance, the younger you are, the cheaper it is. Because the longer you wait to qualify for a life insurance policy, the more costly it's going to be. So, life insurance, how can that benefit you? Well, life insurance is multi-generational, whereas the survivor annuity benefit plan is not. Life insurance, you can have multiple beneficiaries. You can change those beneficiaries anytime you want, any percentages that you want. Life insurance is not use it or lose it because it has living benefits, as we discussed earlier. Life insurance benefits are 100% tax-free. The cash value, the chronic, the critical, the terminal illness, all benefits that come out of life insurance, of course, and of course the death benefit to the beneficiary are all 100% tax-free. Life insurance premiums can be tailored to your budget. So a life insurance advisor or a life insurance agent can run numerous illustrations for you to determine a plan that's going to fit your budget. And it costs nothing, and there's no obligation to determine cost and coverage. Now let's move on to a discussion concerning the thrift savings plan. Now, the TSP Modernization Act is big news within the TSP community. TSP Modernization Act of 2017, that law was passed in November of 2017 and became effective September 15th of 2019. Now, how did this affect the thrift savings plan? Well, it affected it in some very positive ways. And it mostly affected withdrawals. Okay, more options for how and when you can access funds. So many of you probably know that the Thrift Savings Plan, up until the passage of the TSP Modernization Act, limited your partial withdrawal to one partial withdrawal ever during the life of the account. And that has been eliminated. So you have multiple options available. You can take multiple partial withdrawals. So more flexibility, more access to your money. Now, the sponsoring advisor can get you more information on this, on the Thrift Savings Plan, the TSP Modernization Act, a full list of all of the changes and all of the improvements for the Thrift Savings Plan. Our time restraints here restrict us from going into that in all the detail because we could conduct an entire webinar on that subject alone. But you're also no longer required to make a full withdrawal after age 72. Previously, that was the RMD age 70 and a half, and due to the Secure Act that was passed in January of 2020, that RMD age has been extended to age 72. So that's not a misprint in case you were thinking 70 and a half. More payment options for separated individuals. So those that have retired or left service, there are more payment options available as well. Now, the TSP for sure is a great savings tool. However, you need to consider some things going forward with your thrift savings plan. Number one, Congress has a history of tapping the TSP, as evidenced by an article that was published in 2015 entitled "Groups Urge Congress to Declare TSP Off Limits." And quoting the article, the 15 unions and organizations that make up the Labor Council that advises the Federal Retirement Thrift Investment Board are calling on Congress to keep its hands off the thrift savings plan. And there are numerous articles available concerning the management of the TSP, politicians attempting to get their hands on those funds. Good information for you to know, and again, the sponsoring advisor can get more information to you on that and other articles that are available to inform you on that. But also, how about self-management risk? Keep in mind that the allocations within that thrift savings plan, the decisions for making those percentage changes, when to move out, when to move in, are all on your shoulders, unless you employ the services of an advisor, of an investment advisor. Are you comfortable with managing probably the largest nest egg that you have or ever will have in your life? Lifetime income is very important, in addition to your pension. Now, if you utilize a lifetime payment plan with the thrift savings plan balance that you have, you're going to lock up your money. You will never have access to the cash again. This is known as annuitization, and those annuitization models and calculations are available at the TSP website. But keep in mind, if you utilize that option, Thrift Savings is going to transfer those funds over to an insurance company that is going to provide you with an irrevocable immediate annuity. And again, you will have a lifetime payment, but there are a lot of restrictions associated with it. Number one being you do not have access to the cash going forward. Many federal employees are not aware of this. The only safe option you have is the G fund. So the only safe environment that you have within the thrift savings plan is the G fund. And I'm sure you know that global events can rock the stock market at any time. And we have no control whatsoever of what the markets are going to do. But utilizing the G fund puts you in a low yield position. And then the thrift savings plan has a very good option known as the Roth. Roths are tax-free income. When you take them out, you're paying the tax before it goes in. And the TSP Roth was implemented in 2012, a great option. However, the thrift savings plan Roth does have a required minimum distribution at age 72. Now you might think, well, why is this being mentioned? Because a traditional Roth IRA or a Roth IRA, personal Roth IRA, outside of TSP does not have a required minimum distribution. So what are the advantages of an IRA? Well, first of all, self-management risk, as we had mentioned earlier, can be totally eliminated with an IRA. IRAs are multi-generational. Non-spousal beneficiaries can take a 10-year payout. Now, prior to the Secure Act that was passed in January of 2020, the non-spousal beneficiaries could take the inheritance over their lifetime. That has been changed to a 10-year payout. So that non-spousal beneficiary can take 10 years to pay out that IRA to themselves, which will reduce the taxation. That cannot be done with the thrift savings plan. Guaranteed lifetime income is available without locking up your money. Very important point in reference to our previous slide. So IRA programs, there are IRA programs available whereby you can receive a guaranteed income that you can never outlive and still have access to your cash. Very, very important. There are numerous safe money options for IRAs, not just one like you have with the thrift savings plan. So there are many, many programs out there that provide safe money with good solid rates of return. Personalized professional attention from a licensed advisor. So the sponsoring advisor for this webinar segment can help you with all of these things that we've been talking about today. They can do a personal assessment for you. They can do projections for you on your income, your pension, all of these different things that we're talking about. Very important to get some help so that you don't make financial mistakes that you cannot reverse. Costly financial mistakes. So just keep that in mind. But much easier to manage RMDs with the IRA than the thrift savings plan. Why is that? Because you can manage your RMDs with multiple IRAs. As an example, let's say that you have 4 IRAs and you are going to have a required minimum distribution after age 72 on those 4 IRAs. However, you could satisfy your RMD with one or multiple IRAs, whereby with the TSP, you have to take your RMD from that TSP. It is calculated separately. You cannot satisfy your thrift savings plan RMD with an IRA. It has to stand on its own. The RMD stands on its own with the thrift savings plan. Numerous investment options that are not available with a TSP. An IRA has many, many investment options that can be allocated in different investments. And again, an advisor can help you make sense of all of those programs and options that are available. And again, as we had mentioned before, the Roth IRA does not have a required minimum distribution. Now let's move on to the FERS Special Supplement. And the FERS Special Supplement exists to bridge the income gap for FERS employees who are eligible to retire before they are able to collect Social Security at age 62. The benefit pays them a portion each month of what they would receive when they reach age 62. It is paid by OPM and will cease once an eligible employee turns 62, at which point Social Security will pay the amount. So the FERS Special Supplement is a gap insurance, so to speak, whereby you will receive a portion, 70 to 75% of your age 62 Social Security benefit. Now keep in mind, this is not paid by Social Security, it's paid by OPM, but it's based upon your age 62 Social Security amount. Now, if you don't know your Social Security amounts, an advisor can help you find that and determine your full retirement age benefit, your age 70 benefit, and all of the other caveats associated with the Social Security benefit. Let's talk about FERS Special Supplement employee eligibility. So these are the eligibility standards. Number 1, after 30 years of service at or after your minimum retirement age, or after 20 years of service at or after age 60, or under discontinued service retirement or early out. Now, if you retire on an early out basis, you must wait until you reach your minimum retirement age before you can begin to receive the supplement. So in other words, if you are an early out, if you're RIF'd and you go out early and you qualify for the first special supplement through that discontinued service, if you're not at minimum retirement age, you're not going to start collecting that first special supplement. All right, so you have to keep that in mind when you're budgeting and making that decision whether you're going to accept an early out offer. So here's our example on the first special supplement. How much is the benefit? Well, the supplement is calculated by using this formula, taking the years of first service and dividing that by 40. That gives us our percentage. The estimated Social Security income amount at age 62, which can be found on the Social Security income statement or at ssa.gov, multiplied times the above calculated percentage, that equals your supplement. So, for our example, let's say that we have a federal employee with 25 years of service. They are at age 60, and estimated age 62 Social Security benefit is $1,500 per month. We take the years of service, 25 in this example, we divide that by 40, which equals 63%. We then take the estimated Social Security income at age 62 and multiply it times that 63%. And this will give you, in this case, $945 a month, the special supplement amount. Now let's talk a little bit about the Secure Act. We touched on that a little bit during the TSP segment, and some sweeping changes as it relates to retirement accounts, retirement benefits, RMDs, and so forth. So if you turn 70 and a half in 2020 or later, you can stay invested in your individual retirement accounts or defined contribution plan account longer, because the age for required minimum distributions is now 72, and we discussed that earlier. So if you were age 70 and a half in 2019, then you are going to have the 72 age is not going to work for you. You are going to have an RMD. But again, if you turn age 70 and a half in 2020 or later, then your RMD age is extended to age 72. You can continue to contribute to IRAs regardless of age if you're still working and receiving earned income. So you do have to have earned income to contribute to an IRA, but previously if you were at RMD age, you could not contribute to an IRA. But now, regardless of age, you can contribute to the IRAs as long as you're still working and receiving earned income. If you inherit money from an IRA, from someone other than a spouse, you can withdraw the full amount over 10 years to reduce taxes. We did mention that earlier. Very important point concerning the Secure Act. Now again, let me say this, with the Secure Act, we could do an entire webinar concerning the Secure Act. The sponsoring advisor can help you understand the Secure Act and get some documents over to you and help you understand it in its entirety and how it's going to affect you going forward into retirement. Now, we thank you for taking the time to view the benefits webinar. We hope that you found it to be worth your time, and we hope that it's helped you out. Now, we do strongly suggest that you take some time to visit with the sponsoring advisor to continue this educational process and become more knowledgeable about your benefits and prepare for a successful retirement. Education is paramount, and the advisor that is sponsoring this webinar segment has been selected as one that is very knowledgeable about benefits, very knowledgeable about retirement planning, and it is in your best interest to get some help. So we do suggest that, and again, thank you very much for attending the webinar, and we hope that it's been helpful. Thank you.